We have a quick question here from a new subscriber that's basically struggling with a very, very common challenge of basically cutting their winners short and letting the losers run. And they're saying that it's really damaging their psychology right now, as well as their trading account. And they want some tips on how they can possibly solve this. So, the first thing I want to say to you is that you're definitely not alone. This is something that a lot of traders struggle with. It's something that took me a long time to overcome. But the good news is there is, a tip that really helped me and that I can quickly share with you. So, as you know, we like to trade unleveraged when it comes to the majority of our trades, and that means that you can only risk a micro lot for every $1,000 in your account. So if you have a 100 grand account, you can risk one standard lot per trade, or if you have $10,000 in your account, you can risk a mini lot per trade. Now, obviously, it'll be slightly different when you beta adjust your positions. For example, something like the pound Aussie will move a lot more in terms of its volatility profile compared to something like the euro pound, right? So because of that, you don't want to risk one-to-one leverage on each of them from a day trade perspective, because if you lose the pound Aussie, you're going to lose a lot more on that compared to the trade that you take on the euro pound. So you do want to still beta adjust those positions. Now, having said that, one solution that has really helped me is not taking one specific unit per trade, but splitting my orders into multiple units, normally two. So let me explain this. Let's say you have $100,000 account and you normally trade a standard lot. Instead of taking one trade at a standard lot, you're basically going to split your trade into two units of 5 mini lots each. Or let's say you have a $2,000 account. Instead of taking one trade at two micro lots, you take two trades at one micro lot each. Or if you're trading in percentages, rather, instead of taking one position at 1% risk, you're going to take two positions each with a 0.5% risk. So let's go to a chart example and let me see if I can explain this. So imagine that you have your two units. So imagine for example, we want to take a buy trade on the euro dollar. We've decided that this overall area here is a good spot where we want to re-engage this pair to the upside. So we mark out this overall area saying that this is where we want to take an entry. We mark out that this low is where we basically want to anchor our stop. And we look to the upside and we see that, okay, we have that R1 pivot to the upside as a possible resistance or take profit area. But we also know that we have a medium-term bias on this particular pair. And if we just zoom out a little bit, we see that we also have that 114 to the upside for a possible second target area. Because you never know, from a medium-term bias, we might see the market push through that level finally and edge higher in the session. You don't want to miss out on that type of move. So what you can do is, let's say that you normally take 1%, you risk 1% per trade, whatever that is, whether it's 0.5% or 2% or 1%, whatever. So let's say you normally take 1%, one position at 1%, you're now going to take two positions, but you're only going to risk 0.5% on each of those units. So it's basically 0.5% times two. So let's say that you see the market is edging down lower. You reach this overall area where you want to take a buy from, and now you open up your two positions, your first and your second one. Okay. Now, remember that these two positions, it doesn't mean that you're going to risk twice the amount you normally would. Just want to make sure you understand it. It doesn't mean you're risking twice. You're going to risk the same amount. You're just going to split these orders into two parts. So in this example, we have two areas from an intraday perspective where we might expect some resistance to come into the pair. We have that R1 pivot, which is close to yesterday's high as well as the previous high going back to the 9th of July. And then we also have that 114 psychological level, which we know is important from our prior analysis. So what we can do is we can buy some restraint for ourselves and not give up on our winners too quick by basically taking off our first unit when we reach that first area at the R1 pivot. So, instead of taking one position and taking it off at the R1, you take two positions and you take off that first one when you reach that overall area. At the same time, when you do that, you're also going to take your stop loss from the second unit that you have, and you're going to move that one to break even. Now, you would have often heard us say in the video commentary, when we reach areas of significant support and resistance, we say things like, this is a good spot to reduce some risk or bank some pips at specific levels. And that is exactly what we mean when we say that. So the fact that you take off 1 unit to bank a profit will actually buy you some restraint, because that fear of missing out on the unrealized profit that you have is drastically diminished by closing out some profit at least, or banking some profit. At least that's how it works for me from a psychological point of view. And the fear of missing out on a potentially larger move is also diminished because you're still in the trade at that time. And because that second unit is at break even, or at least at reduced risk, the anxiety is removed quite a lot from the trade. And if the market then starts to reject strongly from that first level to the downside that you marked out, nothing stops you from closing out that second position if there is a clear change in the sentiment. But knowing that you've banked some pips already gives you some restraint to let that second unit go, because it's essentially risk-free at that stage. So, if you're constantly closing out winners too quick, you can try this type of technique. It is something that has helped me a lot in my own trading. And apart from that, like we've discussed in a prior video last week as well, if you are closing out winners too quickly, always make sure that you are fully accepting the risk on your trades as well. So not fully or truly accepting the risk that you're taking can make you cut winners short as well. So once you've done your analysis, once you've marked out where you will have your entry, where you will have your stop, where you will have your take profit, accept the risk and just stick to your plan. I literally wrote that out for me and had it on my desk for a long time. Accept the risk and stick to your plan. I repeated it to myself many, many times. Just accept the risk and stick to your plan. And when things start looking, shaky, and I wanted to close out trades, closing out winners too quick, I would just go over some past examples where I closed out trades too early and they ended up reaching their targets perfectly. Those past examples will also help you to enforce some of that discipline, to stick to your plan and just execute it properly. Another thing that you can also do and that you can help is getting better entries from your trades by scaling into positions, right? So instead of taking both your positions, let's say at the top of this range or top of this area that you want to take, you can maybe take a first position here and see if the market pushes down a little bit further, and maybe scale into the position. So you can take a first unit here and you can maybe take a second entry over there. That'll give you a little bit of a better entry price on some of the units. That way, even if you're a little bit early with your entry, you might get filled at a better price, obviously with that second unit. But the only challenge with scaling into positions like that and not taking both of them at the same time is sometimes the market doesn't move deeper into a zone, right? So sometimes you don't see it moving into the zone and then moving up. You might see it rejecting straight from that level and just shooting to the upside. And if you then only took one unit there instead of both of them, you would only have one unit riding to the upside instead of two. And I mean, obviously then that goes besides the point of trying to have two entries to try and reduce some of that risk. So that is something that I used to do. I do it to this day still as well. Taking multiple entries is really something that's helped me to keep my winners running for a little bit longer. I mean, it's really down to that psychological thing. You once you've banked that profit and once that thing is risk free, it really does wonders for your psychology just to know that, okay, I've made something on this trade. The rest is now, just the cherry on top, so to speak, trying to get that 1 to 3 or 1 to 4, risk reward levels for that bigger targets to the upside. So I hope that helps. Any other questions with regards to this, don't hesitate to let us know.